So unfortunately, I don't see a way out of this. The only way out that I see is if Jay Powell came out next week and said, I was wrong. We are wrong. We need to raise rates. We need to bring down this everything bubble. We need to see liquidation. We need to see companies and people going to the wall because we've got too much inflation. But he's not going to say that. Saturday, August 24th, 2024, Monaco 64, home of alternative economics and contrarian views. Well, we're going to look at the dollar. Why is the dollar so important? Well, it's the world's major reserve currency still, even though the process of abandonment of the dollar is accelerating at a rate of knots. We saw the other day Saudi Arabia and China announced, or S&P Global actually announced, that Saudi Arabia and China are going to increase their use of the yuan for sale of oil from Saudi Arabia to China. So it's nothing new, and we're seeing a lot of other non-NATO countries or BRICS plus or BRICS expansion countries trying to use their own currencies to trade amongst each other and use gold, of course, as a base for their monetary system, which in my opinion is a very good idea. Does it mean they're going to bring out a single currency backed by gold? No, but they're not going to be needing dollars. And I think the dollar and the rest of the world's currencies are on the precipice. On the precipice of what? Well, of losing massive purchasing power versus real things. And the major barometer, or the canary in the coal mine, is the price of gold, or the price of the dollar in gold. And why is that? Well, because gold is the ultimate store of value. It's the ultimate measure of value. And like Jim Sinclair once said, it's a revealer of true wealth. So yes, we can see the NASDAQ, S&P, and all other indices go up and down, make new highs. But until you look at everything in terms of gold, you're not really looking at the bigger picture. And why do I think we're getting closer and closer to the precipice, and not just for the dollar, but also for all other major fiat currencies? Well, one of the reasons was the short speech that the chairman of the Federal Reserve made yesterday at the Jackson Hole Symposium in Wyoming. And we're going to look briefly at that today. There's been, of course, some doubt, because you never know with the central bankers, with the powers that be, the people who control the money or the currency in the world. They control everything. They control politics. They control the media. They control education. And you never know whether they're going to do something completely different. And they still could. But there are some people who thought that this time it was going to be different, that the Fed was not going to cut rates, that they wanted to bring everything down, maybe to have a major deflationary collapse and bring in like a CBDC. And that's still possible, but the more I see things, the more I favor now a hyperinflationary collapse. Hyperinflation is really the loss of confidence in the currency. And high inflation is, yeah, it is a little bit of loss of confidence in the currency, but it's also the dilution of the value of the currency. And hyperinflation happens really when the general public, investors, wake up to the fact that the central bank and the government are never going to stop inflating, because up until now, I think people still believe that the Fed and other central banks and governments are fighting inflation. But don't be fooled. They're not. And yesterday, Jay Powell spoke briefly. It wasn't a long speech. And well, he seems convinced that they've won the battle against inflation, just because we're down to almost 2% in CPI. And if you've been listening to my videos for the last 9 years now almost, you know that inflation is not the CPI, and that they can really tinker with the CPI, just like they've been tinkering with the jobs data. Inflation is the increase in the supply of currency and credit out of thin air. And it's only through a central bank system and the treasury of a government or the Ministry of Finance that can happen. And yes, private or commercial banks, they create a lot of this currency and credit out of thin air, but ultimately the reserves they use to do that comes from the central bank, which also creates everything out of thin air. And I tweeted yesterday in response to Powell's comments. Powell says inflation has fallen, but CPI, or prices, is still rising, and M2 has resumed its rise. M2 is the money supply, of course. If the Federal Reserve was serious about maintaining the purchasing power of the currency, we should be seeing these charts going down and not up. So the top chart, I've got the actual consumer price index. And it's from, let's see, what year is it from? It's from around 2010. And you can see that it just keeps going up and up and up. There was a blip there in 2020 when they shut everything down. Prices went down, but you can see that inflation is not under control either by the money supply chart. Money supply has been growing massively since the 70s. And why is that? Well, that's because in 1971, the US currency was detached from real money or gold. Yes, they did try to bring it down under control, and they did a little bit, but it's rising again. So what I was trying to say, if they really wanted to bring back the strength of the currency, they should let the money supply shrink massively, and that would bring prices down. That would actually bring the CPI index down, but we'd have negative CPI. And unfortunately, in this fiat currency system, where everything is done with loads of debt, margin, debt, derivatives, they can't do that, or else they'd destroy Wall Street. They would destroy the banks that the Federal Reserve is supposed to protect, because that's what the Federal Reserve is there for. They're there to socialize the losses of the private international bankers and privatize the profits. And who pays for that? Well, we pay for that, but don't be fooled. And the way we're paying for that is through the cost of living crisis, and it's going to continue. And it doesn't matter who wins on November 5th. Have you heard either side talking about reining in the debt, reining in spending? I haven't. And that's why I think we're near some kind of currency event. And by that, I mean a massive currency collapse. And by that, I also don't mean the dollar index going down, even though it has gone down. That's just another distraction, because all the other major currencies like the yen, the euro, the pound, the Canadian dollar, the Chinese yuan, these currencies are all a derivative of the dollar. So if the dollar goes, they're all going to go. And is it any wonder that countries outside the West, they can see this, and that's why they're setting up their own system. It's called BRICS. That's why they're buying gold to protect themselves. And that's why I've been doing the same thing for years. And some of you, of course, because of what you learned through my channel, have been doing the same. And I think it's going to continue to protect you, having a little bit of gold when things really hit the fan. And I think we're close to it. So now I wanted to talk about some of the symptoms of all this, because the underlying problem, if you look from 30,000 feet, above 30,000 feet from the planet, the underlying problem is the money, the currency, the debt. And then there are things going on like the yen carry trade, the general election, geopolitics, wars, social unrest, division. These are all symptoms of the money going bad, because if the money was sound and the people were happy and prosperous and governments were small and representative, we wouldn't have all these this mayhem going on in the world. So we're still going to look at some of these symptoms though. And as for the Japanese yen carry trade, we had in the beginning of August 5th, a major flare-up of the problems that an unwinding of the carry trade can bring. That was when the dollar dropped sharply versus the yen, as you can see on this chart. And stock markets around the world plunged. The Nikkei dropped over 13% on August 5th. But then things stabilized, and you can see that the dollar rose again versus the yen, but it's created a technical picture called a bear flag. And it's unfortunately, it's evolving pretty much as it should. And what does that mean? Well, if you take the base of the flag here and you measure it up to the top of the dollar back in July, for example, at 162, you get a difference of 15 yen. And then those 15 yen, you take them and you point it downwards from the bottom of the flag, which we're breaking now. And that leads us to 127, which means a huge drop for the dollar. And it could put the cats amongst the pigeons. It could make the beginning of August look really almost like a picnic. So I think there's trouble ahead for not just the currency market, but all asset markets around the world. And of course, yesterday, Jay Powell finally announced to the world that they're ready to change monetary policy. So it's a done deal now that they're going to cut rates on September 18th, I think. I guess the only thing we're not certain about is by how much they're going to cut, either 25 or 50. And this is another symptom or signal I wanted to show you here. And I wanted to thank Geiger Capital. And I found this on Twitter. And he's done a bit of analysis here going back to, to the 1970s. And he shows like after every first rate cut in a cycle, the S&P drops quite a bit in the next year or so. So like in January 3rd, 2001, there's the first rate cut. And in the next 448 days, the S&P fell by 39%. And the unemployment unemployment rose by another 2.1% as well. And then in 2007, September 18th, which is ironic because the first cut in 2024 is probably going to be September 18th. But S&P fell 54% after that first cut. in the next 372 days. And unemployment rose another 5.3%. So basically, yeah, it doesn't look good for the economy, even though listening to Jay Powell yesterday and other central banks, they're going to tell you everything's fine, that mission has been accomplished, that they've reined in inflation, but they have done anything but. So now to the dollar on the precipice. And some of you might have seen these charts already, and I've spoken about fxtop.com, which is a website where you can plot, let's say, not the price of gold in dollars, but the price of the dollar in grams of gold. And up until recently, if you go back to 1953, and the reason we go back to 1953 is just that FX Top only goes back to 1953. Well, in the beginning of this year, the dollar had dropped 98% versus gold since 1953. And there are some other currencies that are already down to 99%. But I've noticed now, if you go to FX Top, as of yesterday now, the dollar is down 99%. And going down to 100%, which is basically the dollar not being able to buy any gold, people not accepting American currency or any other currency for gold. It could take a while. That last 1% could take a year. It could take maybe 2 or 5. But I have a feeling it could accelerate quite quickly. And I'm going to show you why. And I'm going to bring a chart, a couple of charts. The first one is of the price of gold in dollars. And that's going back to the beginning of the century. And it's a monthly chart. And you can see here that, gold is taking off and the dollar is dropping. And the interesting thing about gold taking off like it is that there's very little talk about gold. It's not like there's a gold fever. It's not like Bitcoin or cryptos where everyone seems to want to get involved in. It's very quiet, so it's still early days. But the other chart I wanted to show you to compare with this chart is a chart from the early 20th century from Germany. And it's the value of one gold mark in paper marks. Normally, prior to World War I, it was 1-to-1, of course, because you could take a banknote to a bank in Germany and they would give you a gold coin for it, equivalent. It wouldn't change. But with the war, of course, they left the gold standard. And basically, they were on a system like we're now, where the price of gold rises versus the fiat currency. And the chart here it's from the beginning of 1918 to the end of 23. Yes, it's only 1, 2, 3. It's only like 6 full years. And the chart that I have here, present day, is like 24, 25 years. So it's not the same time frame, but there's something in nature and also in technical analysis called fractals, that you could have the same patterns that look very similar, but the time or the size of these patterns are different, but they're the same patterns. It's like a little wave, looks very similar to a huge wave, but it's a fractal, it's a fraction of it. So this is why I'm worried about it here, and that's why I said the dollar and all other fiat currencies could be on the precipice, because we're going to compare now these two charts. So what comes to my attention here is if you look at the way the gold mark rose from 1918 to the end of 1919, beginning of 2020, looks exactly the same as the rise in gold from 2000 to 2011. And then you notice here that in Germany, up until the beginning of, until the summer, end of 2021 to the summer of 22, or middle of 1922, excuse me, the gold mark was still not rising. It kind of stabilized the fiat currency, pretty much like the dollar has versus gold since 2011 up until recently, up until the beginning of 2024, when we took off and went over 2100. Those charts look really similar. And what I'm afraid now is that this takeoff in the gold price is not really something to be happy about unless you have a lot of gold. I don't even think you're supposed to be happy. You're supposed to be worried, because what this means is that the dollar is on its last legs, just like the Reichsmark here was on its last legs, or the gold, the paper mark. Because from the middle of 2022, you can see how it completely collapsed. And from being worth, from gold being worth just under 100 marks, it went to like, a trillion marks at the end of 2023. So that took about 18 months. And the difference here is the time frame. This might take longer than 18 months just because the fractal is bigger than the one in the 1920s. So unfortunately, I don't see a way out of this. The only way out that I see is if Jay Powell came out next week and said, I was wrong, we are wrong, we need to raise rates, we need to bring down this everything bubble, we need to see liquidation, we need to see companies and people going to the wall because we've got too much inflation. But he's not going to say that. So I'm going to end here with some examples of what happens in hyperinflation. And I'm going to refer to The Great Depression, a diary by Benjamin Roth, because he talks, there were concerns about inflation in the early 30s, and they did have prices rising quite substantially after 1933. But in this entry here, July 1st, 1933, he talks about what happened in Germany. And hopefully this will give you an idea of what could happen in modern day. And it might not be exactly the same, but it will rhyme, I think. So he says here, I read an article a few days ago in the Saturday Evening Post describing the German inflation period. It is enough to strike fear into the heart of the most brave and explains why European nations are demanding stabilization of the US dollar. The German inflation was a huge fraud which benefited the debtors and speculators at the expense of the large, prudent middle class. The following things happened in Germany. A. Bonds, including government bonds, real estate mortgages, life insurance, bank savings, and all fixed value investments became worthless because they were redeemed by debtors with depreciated money or currency. B. Common stocks of industrial concerns soared to fantastic heights and paid huge dividends. When stabilization came, these stocks crashed and only the strongest companies survived. In spite of this, common stocks proved to be the best investment. C. Real estate owners who paid off their mortgages with depreciated currency and held on to it until stabilization came still had something of value. The same applied to purchasers of commodities such as diamonds, etc. D. Industries expanded, built huge additions to their plants, and paid in worthless currencies. Of all classes, the industrialists fared best. E. Professional men were badly off. Yes, and he didn't mention gold, mainly because gold at the time was money. It wasn't like traded or held like it is today, almost like an investment. But as you saw from the price of the paper mark in gold, it was a very safe place to be, gold. And yes, with that, I'm going to wish you all a very good weekend. Take care. Bye.